Good afternoon, fellow realtors. Well, I only get to see you guys once a year. And I can't believe a year's already gone by, let alone a decade. It's 2020. You know, I had a birthday last week, and I decided that I'm going to start announcing my birthday by the decade rather than the year. It just sounds better. Until you go to the liquor store and tell them you're 7 years old, so that doesn't fly. Anyhow, I got a microphone, I've got a clicker. What could possibly go wrong here? I'm going to cover a lot of the stuff that actually Jordan did too, take a few pages out of his book. But speaking of decades, I'm going to talk about the last decade. I'm actually going to go back a little further to 2009, because that's when the market, at least commercial market, crashed. I'm also going to wrap it up, or cover it up with 2019 versus 2018 comparison. Talk a little bit about owner-users versus investors. And the reason that this is important, you'll see later, is that we've had a flurry of activity the last 3 or 4 years from a group that otherwise probably only accounted for maybe 10 or 20% of our sales. And we'll talk a little bit about that and show you some comparable sales that have taken place in that regard. Lease versus vacant, a term coined by my partner Paul Gambardella, a tale of two markets. Buyers' expectations, sellers' expectations. Do anybody here run into those problems where they're kind of pretty far apart? So we're going to talk about that. State Street then and now. We could go on forever about State Street, and I talked a little bit last year about what was underfoot to try to bring back that market. And we'll talk about that a little bit later, but I'm going to give you a couple examples of sales that have taken place. And I'm not sure it's a trend, but you'll see what I'm alluding to later on. And new development. We've already had the Rosewood finished, so that's in place, beautiful hotel now. But most of the development you see going on in town is the apartment development under the city's AUD, average unit density overlay. And that's a significant change to city policy and has created some new inventory. So let's go ahead and, if I can work the clicker right, we'll follow up. Again, I'm piggybacking on Jordan's speech here. I thought it would be interesting to see what the 10-year Treasury has done for the last, actually 11 years, since 2009 at our low. And you can see back in 2009, 3.85 was the 10-year Treasury rate. The reason I'm using this rate, most of you know, is that commercial loans are generally tied to the 10-year Treasury. And lenders generally use 2 to 3% over that to price their loans. So back in 2009, we were looking at loans in the 6s. Fast forward to 2019, and we're half that rate. And our loan rates now are more or less in the 4s. And parenthetically, I had a quote today on a very large loan from a local lender at 3.3% for a 10-year loan. So who knows where it's going to go? And that little yellow line next to that, that basically tells you that today it's gone even lower. 1.59 is a 10-year. Well, my gosh, look at this graph. It's just the opposite. It shows our sales in 2009 at a low of 35. And by the way, there's only about 50 commercial brokers in town, so you can think of what kind of dogfight went on in 2009 for those 35 sales. And then it ratcheted up. We see the graph go up, and surprisingly, gee, as interest rates go down, sales go up. Okay, pretty good economics. And then we level off about 2014. We had some tax changes, and that was kind of the high water mark. But really, we've been pretty steady. If average sales for the last 15, 20 years have been 75, 80, 85 sales, we're right in line, and I think you're going to hear through this talk, the theme is stability. And we're seeing a pretty stable marketplace right now. This next slide just shows you sales volumes, and it's pretty much the same graph. It goes up from 2009, ratchets up, levels off, you see quite nicely in 2016 to 2018. And wow, 2009 was a whopper. We jumped up to $530 million in sales. Part of that, I think, as alluded to earlier, part of that's as a result of more owner users coming on the market and being more motivated buyers than, let's say, our investor group. 2018, 2019, you just saw these numbers, 81 sales, 87 sales, 18, 19. But again, the big jump, $350 million worth of sales to 530. That's a 52% jump. And when I say big sales, I don't know about the residential market, but most of our commercial sales are sub $10 million. This year we had any number of sales that were the $20, $30 million category. So that's a big year, and that's what pushed a lot of those numbers up here. Owner users versus investors. I mentioned this earlier, and it may not mean a lot to you guys, but to those of us in the commercial field daily, when you've got owner users accounting for over 50% of your sales for the last 2 years, that's an extraordinary number. And one of the reasons is that, as with a lot of people that we all know, if you own a business, you ultimately want to own your real estate. It's an investment in your future, and how many businesses have the commercial guys see that have sold for about 12 cents, but their real estate was worth $4 million after 30 years. So that was a good investment for them. The other group that's buying are some big corporate entities in town here who are basically stabilizing their occupancy costs. So they're buying properties, they're holding, they're going to be there for the long haul, and they tie down what their costs are going to be for the foreseeable future. Some of these sales on Patterson Avenue, this was a medical building bought by a medical group, $15 million sale. Again, this is an owner-user sale. It was leased out, partially leased at the time, roughly a 5 cap, which is pretty much our going rate. Cap rate represents the return on your investment if you bought it for all cash, so 5 caps are fairly normal. Santa Barbara County Retirement Group bought their own building out in Goleta on Robin Hill Road, and they're going to spend quite a bit of money and refurbish that building and put in their headquarters for Santa Barbara County. Go clicker. Microsoft, some big names around. Microsoft, Google, Amazon, we've seen them all come into town. Well, Microsoft is your neighbor down in Carpinteria. And you may remember back, lynda.com took over a lot of buildings in Carpinteria. lynda.com got bought out by LinkedIn. LinkedIn got bought out by Microsoft. Ergo, we have Microsoft as a neighbor. And they occupied over 87,000 square feet of buildings down in Carpinteria. Just made a deal with the owner for $30 million to buy his portfolio of properties that they were occupying down there. Square footage, average price per square foot, $350 a square foot. That's a big number for Carpinteria. CenCal Health bought their building off of Highway 154. For those of you in the room who have been around for a while, that used to be an old bowling alley. That building got built about 20 years ago. CenCal has been a tenant for many of those years. Again, tenant in tow in the building, bought their own building to stabilize occupancy costs. Again, another $30 million sale, $500 a square foot. Let's give the investors a little equal time here, and I'm just going to point out some of the more recognizable properties. The B of A building down on the corner of State and Canna Perdido. This is an interesting story in that B of A owned the building and put it on the market for sale, but tied to it a well below market lease rate for the foreseeable future. And it sat on the market for a while, but some very patient money came along and bought that. And you can see their rate of return for their $7 million investment was only 3%. You've been seeing 5s. They settled for a 3% cap. But if you look at the price per square foot, at a little over $300 a foot, that's about half of what that property would have otherwise sold for if they had a market rate tenant in that building. So they bought some good quality real estate. They're going to see the value of that come down the line. The other building on the other side, 800 Miramonte up on TV Hill. Beautiful building, beautiful view if any of you guys have been up there. Investor bought that for $14 million, $725 a square foot. Our prices have been going up pretty steadily, and especially for these unique properties. Another investor property, this has another interesting story. The old fire station that was converted some time ago up on East Valley Road. It was leased for several years by Santa Barbara Bank and Trust, who got bought out by Union Bank, and there's about 8 or 9 years left on that loan. A gentleman came up from Los Angeles in an exchange, the last day of his exchange, identified and bought this property. Now that's the guy that we live for. If you look at these numbers, he paid a little over $2,000 a square foot. Now, Montecito is an expensive marketplace, but you know, $1,000, $1,200 square foot isn't unusual, but $2,000 a square foot. But what he was really buying was the income on that property. And you can see what the return is, 7.43% cap. the rude awakening will come when that tenant moves out, because that rent's about half of what it, or will be half about what it is now. A couple other investor sales, 827 State, that's the Howard Canfield building on the corner of State and Cannon Perdido, where Wendy Foster was. And that was bought by a local investor. Again, you see around a 5% cap. $400 a square foot, which doesn't sound too bad, but a big chunk of that was in a basement underneath, so that has less value, obviously. And 6300 Hollister. Again, I'm showing you some of the big price sales that have taken place that I've been talking about here. And $33 million, this was an old Raytheon building that got remodeled some years ago, multi-tenant building, 6.3% return. Again, that's a number of sales from both investors and owner users here. 600 Pine, oh, I got some more. Investor, 600 Pine, again, the big numbers. 600 Pine occupied by ATK. That's a big building that was on the market for quite a while. Actually, the price came down pretty dramatically because there wasn't a lot of lease term left. That went out at a 7.6 cap. And the mother of all was the Castilian Properties, 2 buildings set there for about $250 a square foot. But look at that sales price. Again, for commercial real estate, over $35 million. That's a big package. Again, my partner coined the term a tale of two markets, and we're going to talk a little bit about buyers' expectations and sellers' expectation. I'm going to show you a couple examples here. Upper State Street, beautiful building occupied by Fidelity Investments, not title, but investments. And the other one was on Victoria Street, occupied by Mullen and Hensel. Both of these went on the market, one after a little bit after the other one. They both had multiple offers, and they both ended up selling over the asking price. And if you look at the State Street property, sold at almost $950 a square foot. Again, we're pushing Coast Village Road prices there at a 4.8% cap rate. Victoria Street property sold at a 4.24 cap rate. Again, 8 offers, sold in about 2 weeks. And what do these two properties have in common? Stability, reliability, no risk. You have investors who are buying future income, it's single tenant buildings, reliable income streams. They flocked all over these 2 listings. Now these 2 other buildings, very nice buildings, very comparable buildings, East Victoria Street and Carrillo Street. Victoria Street was on the market for 14 months, 3 price reductions. A multi-tenant building, wasn't the stability, wasn't the credit tenant, and that building finally sold to a group of investors who were going to basically rehab it, reposition that property, and hopefully make some money. And Carrillo Street, this property was on the market for 6 months, 2 price reductions. About a third of it was vacant at the time, and that property was taken off the market. So this is the diversity between what buyers are looking for, quality. And I think part of that is we have an aging population that is now focusing less on risk and more on reliability, and they are definitely buying those quality properties with quality income streams. These others are more speculative and they're taking longer to sell, and the prices have ultimately had to come down. State Street, we can talk about State Street all day long, but I think we all know that State Street is going through some real pains right now, and I don't think we're going to see a whole lot of recovery for a few years. But I want to give you a couple examples of a couple of buildings, and just because I thought it was an interesting story, 2 buildings in the 1000 block. One sold in 2013 for $763 a square foot. The other one sold in 2019 for $427 a square foot, a 44% drop. Now, I'm not saying that this is a trend and that everything's going to drop through the floor, because again, if you've got an occupied building, if you've got some tenancy, if you've got some income stream that's reliable, you can bet that there's going to be somebody that's going to be more inclined to buy it. But this is just a couple of indications. Same block, same side of the street. Same story here. 2015 for $585 a square foot, 2018 for under $400 a square foot, about a third drop. So State Street in a lot of ways is softening up price-wise for sales. State Street lease rates are softening up, and again, all of you have seen that firsthand. Development, I'm not going to spend too much time on this, but I think this is an interesting subject as well. We've seen some new apartment projects go in town, which is great. We don't have enough apartments in town. Jordan was talking about housing. The city created this program where they increased the density, allowed developers to build more units. You'll see some flack in the paper now that the owners who are building these units are charging market rents. God forbid they're actually charging market rents for these things. But market rents meaning you're servicing a need. There's somebody who's buying those that are paying those rates. Right now, the numbers are, there's roughly 266 units that are approved, 149 that actually have building permits, and we've got 277 now that are already completed. So we got a total of about 700 units maybe coming online. But I can tell you of the approved units, the cost of construction has gone up. Property owners' land values think that they've gone up dramatically. Of those approved units, I would doubt that we'll see more than a third, maybe 25% of those actually come to fruition. So we may end up with 500 or 600 units overall. That's 1% or less than 1% of the apartment stock in Santa Barbara. So it's not making a dent, but it is adding to the value of downtown, which is primarily where these are going, and offering opportunities for some of these new companies coming in, the Amazons, the Microsofts, everybody else who's coming downtown and needs a place to live. These are some pretty pictures of properties under development here. 414 Chapala, again, 21 units, about 3,200 square feet of commercial. Canaperdito Street, that's over by Milpas, the old McConnell's ice cream lot over there. That's going to be 41 units downtown. The new home of Radius, 214 East De La Guerra. We're building 5,500 square feet for the company, and we're adding 26 apartment units on East De La Guerra. And 634 Anacapa, that's the newest building to be finished. And I invite you to drive by and see the level of quality that's going into some of these buildings. Again, they're by design. The developers are putting that effort into those developments. But the city, as we all know, if you've ever developed anything downtown, has a lot of guidelines, and these buildings are expensive. And if you see big top dollar rents, that's so the developers are incentivized to build these. But this is a beautiful project downtown. And again, I think it's worth everybody taking a look at that. That's the phase of things to come. All right, my conclusions today. Stability. I think, again, echoing a little bit of what Jordan was saying, we're leveling off. We're seeing a balance between buyers and sellers. There's always differences of opinion, but I think we're seeing the market level off. Also, what Jordan was saying about inventory, that's our wild card, is that we see our numbers, from you saw from the graphs earlier, of the numbers of sales going up, and that's all good news. And leveling off, that's all good news too. We like stability, but our inventory is going to dictate what we do in the years to come. And that's just depending on people's estate planning, people's motivations, people's interest in changing properties, trading properties. That's out of our control. Quality, focus on quality. I showed you a couple of buildings that had feeding frenzies trying to get buyers in to buy those buildings. That's quality that they're all flocking to. State Street, again, you saw kind of what an example of what's going on there. I think we've got a long road to recovery. We're going to need to see some housing go in State Street. I think we're going to see that. We've already seen Amazon move into the old Saks building, and that's a real shot in the arm. So we're going to need that kind of activity, and we're going to need the cooperation of those property owners as well to help State Street recover. And the wild card, nobody's brought this up yet, but politics. What in the world is going to happen this year? Everything is nice and rosy, we're comfortable, interest rates are down, we're selling properties. So are we going to end up with Donald Trump for 4 more years? Or are we going to have Santa Claus running the show?